Let me ask you about that a little further, because there's something there that I'm struggling with a bit as I listen to you. My house, for example, I always thought of as my main asset. But in reality, when I'm thinking about it, it's something that takes money out of my pocket, doesn't give me an income. On the contrary, it's a substantial expense every month. So is that an asset or a liability?
Well, John, this is the thing that's interesting is I love the accountant's answer, it depends. And the fact is that there's great tax loopholes available for your house. We call them home loopholes. Now, if you're doing it the normal American way, where the more money you make, the bigger your house is, and you're just struggling to own this house, and now you have to hire a housekeeper to clean it because it's so big, you have to buy more furniture, and you have to decorate it, and it's just taking you money away, well, that's a liability. But if you're taking advantage of some of the tax loopholes, for example, buying a house, maybe fixing it up, living in it for 2 years, and then taking tax-free gain from it, if you're married up to $500,000 every 2 years, well, that's a way that actually your house can put money in your pocket. So I love the answer, it depends.
Same with a car?
A car could be, generally people think of that as a depreciating asset. But if your business is paying for it, or we could even have ways that the auto is just an integral part of your business. Say you've got a delivery service or a chauffeur or something like that. Clearly your auto becomes an asset then.
You mentioned depreciation, which is a familiar term and I sort of understand it. But can you explain it from your perspective, what this term really means?
Well, it's interesting because there's a couple of different things to think about when we use that word depreciation or depreciating. When I talked about the car, I said it was a depreciating asset, which means it's going down in value every year. You might have paid $80,000 for that really nice car, and next year it's really only worth $60,000. It's a depreciating asset. On the other hand, most real estate investments go up in value. Those are called appreciating assets. And yet at the same time, we have that same element of something called depreciation in your real estate. Now, let's just really flip this on its side. When it comes to real estate, even though the property is going up in value, it's appreciating, the government says, we're going to let you take a special tax break and let you depreciate off a portion of the value. In fact, depending on the property, we're going to say in 27 and a half years if it's residential or 39 years if it's commercial, we think at the end of that it's going to be worthless. We're going to let you completely write off the value of that. That's a phantom expense that helps your tax bracket. So it's an asset that goes up in value. In this case, we love depreciation. But if it's an auto or your clothes you're buying or something like that, it's going down in value. We don't like depreciation.